Hi, I'm Keith McCullough. Welcome back. Today what I wanted to do is review a note we put up on our website on Thursday suggesting that it was not a good time to affectionately buy the damn bubble. Now, we've been calling it buy the damn bubble because, of course, we've been bullish. But this has changed in this most recent week, and it's not just because we're trying to tell you that it was a good spot to sell. There's a confluence of three specific things that I want to hit on first in this first slide that you can see that really came together. They really fit the two big parts of what we do. From a research perspective, growth slowing from a consumption perspective in the U.S. is a major problem in our model right now, and yes, that's new. The second part would be really the quantitative side of the signal, which has to do with the market, number one, making lower highs, and number two, breaking our immediate term trade momentum line of 1837 support. Now, when we take that point and say, okay, look, what is immediate term trade momentum? Immediate term trade momentum is what it is. It catches people off sides. The most amount of people are caught off sides at the most inopportune time. This is what markets do. They impose pain on people. So just breaking an immediate term trade line of support wouldn't be enough for me to change my mind. Research would. But again, let's look at the S&P 500 from an immediate to intermediate term trend perspective. And you could see on this next chart, we're just showing you a 3-month chart. Okay, the momentum's out of the stock market, 1837. For now, if you were to close above 1837, that would be bullish. That looks very unlikely today. But again, that's what it would be. 1779 is our intermediate term, which is different, obviously, than the immediate term. Our intermediate term trend line of support at 1779. So what I need to do is I need to wait, watch, and see if that line confirms. It might today, but the thing that you're not going to see me do is buy an up open or something like that. People pointing to, green arrows. Who cares about green arrows other than somebody who's watching the screen who has never traded a day in their life? We're not trying to tell you to do that. We're telling you a risk management plan with a repeatable process. If 1779 holds, maybe it gets interesting to get longer again. For now, we're going to wait and watch. Now, some more reasoning on that with some charts. The dollar, commodities, and specifically consumer stocks, I'm going to rattle through these fairly quickly, but the dollar last week was an inflationary signal. So, in other words, and again, most government people aren't going to tell you this, when the dollar goes down, the purchasing power for Americans goes down. So again, the purchasing power eroded by another 0.9%. The dollar's down like 2.2% in the last 6 months. That's a problem. So is the dollar breaking and failing really at our trend line, which is right around 81 on the US dollar index. So again, that's a major macro signal that again is a growth slowing signal for us at this juncture on the margin. Next chart shows you the upside down of that, which is in line with Hedgeye's core and really our number one global macro theme for the first quarter, which is of course inflation accelerating. Now, if you can't see inflation accelerating, whether on the employment base, on credit metrics, on really anything that we talked about, now you can see it finally where it's most obvious, which is in the commodity complex. So last week, the CRB index, which is 19 commodities, closed up 1.5% on the week, with the S&P 500 being down 2.6% on the week. So again, drastic outperformance for inflation expectations versus the S&P 500 itself. So again, people are getting worried about growth slowing on the margin. That would be easy to see because growth was so good last year, particularly at the highs in the late part of the third quarter. So again, watch out for that. Now, if consumption growth is under duress, what do? You sell consumption stocks. Look at what we see in this next chart. And again, U.S. consumer discretionary charts look awful. They've looked awful since the beginning of the year. They're down about 5% for the year to date now, which is miserably underperforming the S&P 500. And again, it makes sense. So go back to the fundamental playbook at Hedgeye that says, look, inflation accelerating does what? It slows real inflation adjusted consumption growth starts to slow. So again, this is why we've been so bearish on things like casual dining stocks or regional casino stocks or retail stocks. I mean, this is not what we want to buy. We want to be long inflation expectations, things like gold and coffee. You've seen the things that we've been long that have actually worked. That's what we want to be invested in. It's an investable theme, and it works both ways. Now, the final thing that I'd hit on is the calendar. This is what is not obvious to a lot of people. So if you come in the morning, you see the green arrows, you're having like a dopamine type moment in your mind. You're all excited and emotional. I mean, first of all, check that at the door. It has nothing to do with what you should be doing during the day. What you should be doing is looking forward at the calendar. So at the calendar, you can see both on Tuesday and Thursday, we have negative growth slowing events pending. Now, if you don't have a research team or a research view on this, you would have no business saying this. But we would say unequivocally that durable goods have a high probability of slowing tomorrow. So that would be a bad data point for the market to absorb. And then moreover, the market has to deal with GDP growth slowing. Now, as you know, we've been very bullish on GDP growth accelerating. Now, it would be easy, and again, this is the fourth quarter number, so it's reported on a lag, but it's very easy to see growth slowing on the margin versus an epically high 4.12% GDP number in the third quarter of last year. So again, you got durable goods slow, GDP slows, and then finally you're going to wake up Friday morning, if you haven't been body bagged enough at this point, and the PMI number is going to go back below 59 or 60 or something like that. Above 60, just FYI, for those of you who don't do macro a lot, staying above 60 for the PMI, the ISM, any of these high-frequency economic data points is very hard to do. So the probability of being below that is actually quite high. So again, to review, you have a macro calendar, understand what your catalysts are. But in the background of that, have a research and quantitative process that instructs you to really navigate that macro calendar. That's why we're not as bullish as we were. That's why we're not buying the damn bubble and why we didn't buy the damn bubble late last week. I'm Keith McCullough. If you have any questions on this, please ping me. @Keith McCullough is my Twitter handle.